Welcome. My name is Jason Watson with WCG Incorporated, and I guess we're rocking the handheld mic today. Joseph Bassett with WCG, as well as Rachael Weber. This is a Bourbon and Business Tour podcast, and we're hosted here by Axe and the Oak in Colorado Springs. And real quick, WCG Inc. used to be Watson CPA Group, and we are a tax and accounting firm here in Colorado Springs. Today, we want to talk about some tax deductions, right? Because that seems to be everyone's favorite topic, right?
Certainly.
Yeah. People like to make money, but then not pay any taxes. So, which is great and all. We are going to talk about the car deduction. That's always the one that we get all the time.
Especially
should I
at
buy
the
a
end of the
car?
year.
Should I not buy a car? We're going to talk about meals. Joseph did a whole video on that. We should have people check that out. Yeah. And then travel. That's not as big, but I think the car and the meals is the biggest stuff. And then in our next segment after this one, we're going to do home office and then a bunch of goofy ones like country club dues and all the other stuff that we get asked all the time. So, Rachael, tell me a little bit about when somebody calls up and says, hey, Rachael, should I buy a car for my business or not? What are some of the things that are going through your head?
Do you need a new car?
Do you need a new car? Okay, so you're telling me that we shouldn't buy an asset, a depreciating one at that, just for a tax deduction?
No, you shouldn't. Yeah.
Okay, so the purchase should have an operational necessity to it?
Yeah.
Okay, all right, so do you need a car? Let's say I've convinced myself, and needs and wants sort of occupy some space in my brain. So I want, therefore I need, and I've convinced myself that I need a car.
Okay.
What's your next thought?
Well, who's going to own it? Is your business going to own it, or are you going to own it personally?
Right, and that's what I'm asking you. What do you think I should do?
What type of driving do you do, and how much money are you going to spend? Are you looking at a purchase of an $80,000 car, but you only drive 2, maybe 4,000 miles out of the year?
Okay.
Maybe it would be better if you owned that personally and took the mileage.
Okay, yeah, and that's great. So we've talked about this before in other segments too, where the bookends, if you will, are if you have an expensive car, high miles, expensive car, low miles, maybe that's best suited in the business, because we're going to get depreciation hits just based on time alone, right, of this car aging. Might as well make those hits be a tax deduction. Otherwise, we could do a car where it's inexpensive and we drive a ton of miles. I'm thinking like Realtor and a Toyota Camry or something like that. Maybe that's best owned individually, and then we take the mileage reimbursement from the business. Exactly. How about all the soft, squishy middle stuff? Let's say $60,000 car and you drive 10,000 miles a year.
How long do you keep the car for?
How long do you keep a car for? Yeah, are you one of those car recyclers? Yeah. So what do you think, Joseph?
Yeah, same thing. How long are you going to keep the car? Because, I mean, if we take depreciation, you're kind of stuck doing actual, right? And half of the mileage rate is made up of depreciation, right? So if we take depreciation, you're stuck doing actual.
Right.
Now you're only getting half of the actual expenses.
Right,
But
yeah.
if you're going to flip that car every 3 years, maybe it is good to have it owned by the business.
And that is a challenge where if we're keeping the car forever, even if it's expensive, we might be best suited to have that car owned individually and take a mileage reimbursement. Our job as CPAs is not to save you taxes just today. It's to save you taxes, throughout your lifetime, or at least through the foreseeable future. So sometimes people want that immediate tax deduction, and we will, let's go ahead and pan this out over several years. You'll be better off. So we also leave room for the ego. We all have one. It's okay. But when you say your car is owned by the business, there's a little bit of a sex appeal to that, right? When you go to the cocktail party and, it's a company write-off for me, like it's magic money. It's not really real money when it's a company car. So, yeah, you're exactly right. Let's kind of move on from that. Well, let's talk really fast about depreciation. Right now, we're living in this cool world where we can do 100% bonus depreciation on heavy vehicles, right? And that's defined how?
6,000 pounds.
6,000 pounds, right? I made the mistake of confusing curb weight with gross vehicle weight. And there are some cars, their curb weight is less than 6,000, but their gross vehicle weight's over 6,000. So a technical difference, it is gross vehicle weight, not curb weight. But that allows us to do 100% bonus depreciation, write that car off, deduct the 100% of that car in year one, right?
Yeah.
What happens if we have a car that's less than 6,000 pounds?
We're limited.
We're limited.
Yeah.
All right, what's the max?
It's not as great. Well, you got 10,000 or 18,000, depending upon whether or not you want to take bonus depreciation
Correct.
with it.
Yeah, exactly. So really, we're looking at 18,000. Most
Yeah.
people are going to want to do the bonus, get a little bit of a bird in the hand. One of the questions too that we commonly are asking the client when we are looking at, do we want to depreciate this vehicle as a company asset or get reimbursed by the mile as a personal asset being used for business use, is this year a great year compared to next year, right? So let's say I go, Rachel, I want to buy a company car. You're like, do you need it? Again, needs and wants occupy the same space in my brain. I say yes. And then you say, well, Jason, it's December 31st. Is this year an exceptionally good year, or will next year be a good year? And if next year is going to be a much more of a bang-up year, a higher income year, we would probably just delay the
Postpone
purchase.
it, right.
Yeah. That way we can match the deduction against a higher income. So that's another factor that goes into all this as well. So what other things do we get from cars? Leasing versus financing, that's a common one. Yeah. What else were you going to say?
Whose name does the insurance need to go in?
Yeah, that's a big
Title?
deal. That's a really, really big deal because think just kind of go back to like the basics of rights and obligations and risk of loss and title and all that stuff. For it to be a business asset, it has to be titled in the business's name, right? What happens to insurance though sometimes?
It usually goes up.
Yeah. So your insurance agent's like, oh, you have a commercial policy. And you're like, look, dude, I just drive this around like I do any other car. I'm not like I'm not a trucker, So what sometimes can happen is you can title the vehicle in both the business name and you individually as tenants in common, and that allows us then to maybe have some wiggle room. It's titled in the business, yes, and maybe from the insurance perspective, it's a personal vehicle. Yeah, and folks have to check with their insurance agent on something like that. But that's another big conundrum as well. So can we have the company own the vehicle and get reimbursed for the miles?
No.
And how often do we see that every year?
Often.
30, 40 times. Yeah. We'll see auto fuel, we'll see auto insurance, we'll see payment, and then we'll see mileage reimbursement. It's like, do you have two cars? And sometimes that happens, but typically they're double dipping, right? Which is frowned upon.
Sometimes, yeah.
All right, let's move along. Joseph, you just got done doing a big video on meals.
Yes,
Right.
My favorite subject.
His favorite subject, yeah. I like to eat too. So I have to work out every day because I like to eat. Tell me about give us a little bit of history. Like, what was the rule 3 years ago? And then talk about how it was in flux for a little bit, and then tell us the rule today.
Right. So, we're kind of back to the same place it was 3 years ago. So deducting 50% of your meals. Entertainment is gone now, though, and then it was kind of in flux for a little bit when the Tax Cuts and Jobs Act came out in 2017 because, nothing against them, but it looked like it was written in crayon, so...
It was written in crayon.
Yeah, so... they kind of reissued it and cleaned it up a little bit so it was, legible, and then we interpreted that so that we could tell, clients, what they can and cannot deduct now.
Yeah, so the old rule is now today's rule minus entertainment, like you said.
Right.
The old rule is, and still is now, where 50% of the meal is deducted, provided that you are meeting with a business associate, let's say, and the meeting has to be for business purposes. The meal is just secondary. Now, in reality, probably not, but that's how the code wants you to think. Hey, we got together to discuss business. Oh, and we, by the way, had a meal, right? But yeah, Section 274 was butchered badly with the Tax Cuts and Jobs Act. They didn't change that section. It still is just as bad as it ever was from the Tax Cuts and Jobs Act, but the IRS came out with a notice because the AICPA, us professionals, business owners were all like, well, what are we doing?
Yeah.
So they basically came out and said, it took them 5 pages to say this, but it says, hey, old school is new school, so don't worry. So tell me a little bit about entertainment. What happened to entertainment, Rachel?
It's no longer tax deductible, so it's all personal.
So I can't take you to a baseball game? Do you like baseball, by the way?
I do not like sports, I'm sorry, but
Wow, that's
Take me to
Yeah.
a baseball game.
that's some fine print on the profile that I overlooked.
But you
Okay.
could, maybe buy a meal at a sporting event if it's separate and still get a partial deduction if it's a business, you know.
Exactly. So that's the example the IRS uses. Hey, taxpayer A takes taxpayer B. No one has names. So Mike takes Bob to a baseball game and buys him a hot dog. The tickets for the game, no. The hot dog, yes.
Mm-hmm.
So provided that, again, there's a business purpose
Purpose,
for that
yeah.
meeting and stuff. So talk to me about disguised entertainment. What are your thoughts on that?
Are you talking about staff functions?
Well, disguised entertainment where the price of the meal is so exorbitant,
Oh.
it includes entertainment.
Yeah, it's not supposed to be lavish.
Yeah, like
right.
these baseball tickets are free, but the hot dogs are like $100. So we can't do that either.
No.
So, how about the de minimis stuff, the office stuff, all that? How's that work?
If it's for your employees,
Yes.
then it's tax deductible, and
Okay.
there is
At
no
what rate?
there is no limit if it's on your premise.
Right.
Yeah.
Yeah.
And it's for your employees. For the
Right.
public, maybe it's part advertising. Then you have a regular 50% business purpose.
Okay, perfect. So Tina, in her benevolence, wakes up one day and decides to buy us some pizza so we can work through lunch,
Mm-hmm.
right? So we can get more things done. Because that's her motivation, right? So that's 100%, right?
Mm-hmm.
Coffee and donuts,
Sure.
100%. How about parties, like picnics and all that stuff?
Mm-hmm.
100% as well, right? So things that promote goodwill and all that stuff. Those are 50%. But like when you talk about picnics and all that stuff, that's different. So great. Talk to me a little bit about this guy Sutter.
Right. It's a very ambitious man. He tried to
Dr. Sutter.
Dr.
Right?
Sutter.
Yeah, we have
correct.
to make sure
Yeah,
we
gotta get that
title
Correct.
correctly. Yeah.
But he attempted to essentially write off every meal that he had as a deductible business meal, and he now has a rule named after him because
Yes.
of that.
Yeah, so he was clever, I guess, and maybe audacious. There's a fine line between those two. But yeah, he just made every meal that he had with a business associate. So he never ate alone. So, and the IRS basically said, look, you can't have substantially all your personal expenses being business deductions. It doesn't make sense. So, and we talk about unreasonableness, right? Those are all disallowed. He probably had some that were legitimate, but because he was so unreasonable and so audacious, they just said,
Disallowed all?
yeah. I'll have to look at the court, the court case, but yeah, it was pretty bad. No entertainment. We've kind of gone over that. Tell me a little bit about travel, meals. We have a lot of business owners who say, "Hey, I drive around all day." So they're a sales rep for Big Pharma, right? I whip through Chick-fil-A, and grab me a chicken sandwich. What do you say to that?
If you didn't travel, would you have to eat lunch anyway?
Yeah, exactly. Yeah. How could they convert that travel, or what type? I should say it differently. What type of travel would they have to do to make that business meal, to make that meal a business
A
meal?
business meal? I think you're looking at long distance travel where you're.
Overnight rest.
Yeah.
Substantial rest.
Yep. So they travel far enough where they need substantial rest. Now that becomes a business meal, deductible at 50%. But yeah, people are like, I drive around all day and I have to eat. I'm like, well,
Yeah.
kind of like you said, if you didn't have to drive around, would you still have to eat? Well, yeah. Okay. So, no, that's great. Let's kind of move on here to travel. Travel gets kind of interesting as well, and we're gonna just kind of focus on domestic travel. I think international, with their 1 week rule and all that stuff, we don't really see a lot of that with the clients that we serve. But talk to me about travel deductions in general, Rachel. Is the IRS happy with those?
No.
You say that so quickly.
Right. There's a lot going on with travel deductions that maybe doesn't have a business purpose. So,
Okay.
if you're incorporating your travel along with your vacation, your
Right.
family, you got to think about what is the valid business purpose when
Right.
you're taking you and your 4 kids along.
Yeah. My dad got in trouble because he would drive from Madison to Keystone to go skiing. He took all of us, and he would write it off through the business because he was looking to expand out here. And he got audited and lost, as he should. So I learned that lesson quickly when I was like 13. So, but yeah, so absolutely, it has to have a business purpose to the travel. Can you do some personal things though in your travel? Okay, so give me an example of one.
I'm thinking like 25% of the time, if it was not business purpose, would probably be acceptable for your travel. So if you had to go to a convention in Las Vegas, and at the same time you're bringing your family members to Las Vegas, and they're going to do their own thing there,
Sure.
then there is a business purpose. Your time is spent doing that business purpose. So a business deduction is going to be available to you.
Right. On the travel for you.
Yeah.
The hotel, who knows, might have to split that up. The IRS, the way I read it, is that if your business trip is more than 50% for business, then the cost of travel is deductible. But we were in an audit. The client wasn't ours. We didn't do the tax return, but I was retained to help with the audit. And the guy had a receipt from United Airlines showing like $1,800 for some flights between here and there. And the agent, and she's now retired. She was great down there at the IRS office here on Circle in Colorado Springs. But she was like, "Well, can I see the actual tickets?" I was like, "Why? We got a credit card statement. We got this thing from United saying we got all the things you need." She goes, "I want to make sure he wasn't traveling with his family." I'm like, okay, fair enough, And he wasn't. He just bought a very expensive first class ticket. But anyway, it was very interesting, like you said, that hey, you can deduct some of this stuff.
Yeah.
But, let's talk about like let's say you go to that Las Vegas convention on a Thursday, and you also are going to do some meetings in Las Vegas on Monday. But Saturday and Sunday, you're on your own. What does the IRS say about that?
I would assume that your convention and your trip on Monday is a business deduction. And if you're looking at 50%, then you've got Friday, Saturday, and Sunday, 3 days. So it might not qualify.
Right. However, if you can demonstrate that going home would have been inconvenient or too expensive,
Yeah.
So as I read it, that Saturday and Sunday is fully deductible for lodging and 50% for meals like you normally would get, just because, you saddled business on the front and back end. And 3 out of 5 of those days were business related. So then the travel is also deductible. So anyway, that those are kind of some interesting examples.
Yeah.
Somebody spends an extra day somewhere to see their mom. We've had folks that have traveled to their rental, and usually their rental is somewhere where they used to live, right? That's how most people make rentals. They lived in a house, couldn't sell it, made it into rental, and they go back to check on their rental, maybe fix some tile or whatever, but they also see mom and dad because mom and dad live in the same city. Well, okay, what's the purpose of the trip? Please tell me that it's the rental. And that seeing mom and dad for lunch was incidental. Yeah, exactly. So spouses and kids, that gets really murky when we start adding spouses to the payroll. We add kids to the payroll. Now, if they have a legitimate business purpose, great. And then we can also bring them along, on our travels. That's awesome. But people who have their spouses tag along without a business purpose, we got to back up those expenses, right? So record keeping, you did a whole
Right.
blog post on
Yep.
record keeping.
Yep.
So you're a record keeping expert.
Yes, I would say so.
Tell us about record keeping.
Yeah, so really the two big parts to record keeping is you need a record, obviously, and then you need something to document the expense. So, the record can be a journal, an Excel spreadsheet, but then that documentary evidence, it's got to be something to prove it. So bank statements, like you said, depending on what it's for, like that auditor said, she wanted to see that ticket to see what's in there. Same thing if you go to Walmart, right?
Right.
If I spend $200 at Walmart, is that all office supplies, or are there some diapers in there? So
Right.
that's always something that we go back and forth on.
Yep. No, exactly. So the record is that log, QuickBooks, Excel, whatever. That's your log, and then the documentary evidence has to show date, payee, business purpose, and the amount. Right. So, and you can get away with a little bit of just using your credit card statement, typically not for travel, meals. Those things are just, IRS wants flat out receipts, period. But everything else, you can sort of introduce some reasonableness, i.e. the Cohan rule, where you can say, look, we're an accounting firm. There's no way we're not going to buy paper ever. So I don't have a paper receipt. I bought a ream of paper at Office Max. It's probably legitimate business deduction. So anyway, well, great. Well, we talked about the biggies that we experience daily, maybe even hourly. I'll have the car conversation probably 3 times a day sometimes. But we talked about the car, whether we should buy it in the business or not. Do we need a car? Yes or no? All those questions. We can help people with that decision easily. We talked about meals. Nothing's really changed there. Old school's new school, just no more entertainment. And then we talked about a little bit of the travel expenses as well. One thing I did want to say too is that you could travel in on a Tuesday night and have a meal with somebody Tuesday night and then meet with them all day Wednesday, like in business meetings. That meal, because its nexus to the meetings is so close, that it becomes a 50% business deducted meal, even though it might not have a specific purpose, was not business. It was so connected to the purpose of
You
the
being
meetings
there.
the next
Yeah.
day. Exactly. So anyway, Jason Watson for WCG Incorporated. We have Rachael Weber and Joseph Bassett, both tax professionals for us as well. We're here at the Axe and the Oak. They've been gracious enough to host us, and super quiet too while you guys are getting ready for opening. We should make some more noise, like some blenders and ice and stuff. But anyway, this is a part of our Bourbon and Business tour. And again, we thank you for joining us, and we'll talk to you real soon.